Great. Hi, everyone, and welcome to this webinar on mobilizing capital for agricultural development with the Development Credit Authority. My name is Shyam Sundaram. I'm an associate partner with Dahlberg Advisors, working with USAID on the ISP Investment Support Program team. So before we dive into this webinar, wanted to hand it over first to Patrick Starr from USAID to kind of frame out why we're doing this webinar and how this fits into a broader series of webinars. So over to you, Pat, and then we'll kick it off with the content.
Thanks, Shyam, and thanks to the Investment Support Program team for being here this morning, as well as to Megan Rapp from the Development Credit Authority to walk us through this webinar. Just a quick bit of background, I'm a financial specialist here in the Bureau for Food Security, and as part of my role, I work on agricultural finance interventions and coordinating our activities under the Global Food Security Strategy. And among those activities is a broader promulgation of our activities and some of the chief topics that are driving some of the agricultural interventions you see around the world and that you see at the mission level. So this is the first webinar in a series of 5 that will be carried out over the course of the next few months, all coordinated with our team at the Investment Support Program. And the remaining 4 webinars will be touching on some of those drivers that I talked about. So understanding what makes an ag business investable, looking at how to engage with local financial institutions, what drivers in youth employment and ag business are important to consider, and then finally wrapping up with investor perspectives on agriculture and emerging markets. So all of these topics are we see to be very key topics in unlocking agricultural capital for agricultural businesses, and we hope that you find these webinars informative and hopefully can use some of these tools on the ground in your programming. So thank you to the team, and I'll turn it over to you guys to run through the objectives and the content.
Fantastic. Thanks so much, Patrick. So we move to the next slide. What are we covering today? So today's session is on mobilizing the Development Credit Authority for agricultural development. And so we are talking a little bit about kind of what the DCA is, how it works, why it's important, and what are the different products. And then spend the kind of second half of the webinar talking about how it can be applied and actually kind of digging into some of the best practices, how to use it and how it can be combined with other tools that are at USAID's disposal to really help catalyze agricultural development and agriculture. And at the end, provided we have time, I want to walk through a quick interactive case study kind of go into kind of what the other content is, want to give a bit of space to just introduce ourselves. So as mentioned, my name is Shyam Sundaram. I'm an associate partner at Dahlberg Advisors, working with the Investment Support Program team. I lead a lot of Dahlberg's work on talent, training, and leadership. And I'm also particularly passionate about the area of agricultural finance and investment. And previously, I've worked with Patrick on pulling together a 3-day agricultural finance training for USAID staff in DC. That's now being rolled. Again, to give a quick introduction to her, and then Mark as well. And Megan, you might be on mute.
Hi, everyone. I'm Megan Rapp. I'm with the Development Credit Authority, and I've been in the office since 2011. Worn multiple different hats in our office, but right now support some of the regional teams as well as lead our office's strategy, and I'm really excited to be here.
Good morning, everyone, or good evening, depending where you are. I'm Mark Peterson. I'm a project manager at Dahlberg. I'm also the project manager of this project, which includes the webinars that Pat mentioned in the beginning. I've worked as both a consultant and an entrepreneur, mostly on topics related to inclusive finance, strategy, and bottom-of-the-pyramid business models. And I've been on the other side of this conversation as well as a CFO and co-founder of a for-profit business in an emerging market that worked to secure financing.
Fantastic. Thank you, Megan and Mark. So digging into just some of the setting kind of the context before we dig into the content. So if you look at the next slide, essentially just quick rules of the road for this training. One, definitely do ask questions. We want this to be as interactive and helpful for you as possible. If you're signed in on the Zoom, you have a chat function on the right-hand side. Feel free to use that. If you just want to dig in and dive in with questions, feel free to unmute yourself and interrupt us and ask questions. That's actually very much appreciated. But really do make sure to kind of dig in and ask questions if anything is unclear. And then if you're not talking, do remember to mute yourself. It can create background noise, and so just want to make sure the audio is as clear for everyone as possible. And then finally, before we move into the content, I want to just clarify a few key terms we'll be talking about over the next hour and a half on this webinar. And we put them up on the slide here. The first is agricultural finance. And so just to be clear, this is about the provision of multiple types of services, direct and indirect financial tools, to support on and off-farm agricultural activities. So this is what, for the purpose of this training, what we mean by agricultural finance. Agricultural finance intervention are those kind of tools or programs or initiatives that can help catalyze agricultural finance and catalyze private sector investment into the agricultural space. And then for the purpose of this training, we'll be talking about agribusinesses a lot. And these can be kind of large and micro businesses kind of anywhere along the agricultural supply chain. For the purposes of this webinar, we're not including smallholders as part of that. There's a wealth of literature and in fact, discussion to be had on smallholder farmer finance, which we can definitely talk about at a future date. But for the purposes of this webinar, we won't be focusing our terminology on agribusinesses there. So with that, I'll pass it over to Mark to take us through a bit of the context setting, and then to be able to dig into what a DCA is. Over to you, Mark.
Great, thanks, Sham. So we wanted to start off today's webinar by talking about, why the DCA in agriculture is so important. So we want to talk about kind of the size of this financing challenge that we're going to talk about, why this gap exists, this financing gap exists, and then how the DCA can be used to fill this financing gap. And so to start with kind of the size of the challenge, to achieve the UN Sustainable Development Goal of zero hunger by 2030, a lot of money is needed, $480 billion roughly a year to strengthen food security, to improve nutrition, to improve productivity by investments in things such as trainings and farm equipment and new kinds of seeds, and just a wealth of activity that's needed. A little bit less than half of this money is being provided today, but more than half is missing today. There's this huge need. The good news is that this money is out there. It exists, mostly in the private sector. The bad news is that it's still sitting on the sidelines. The private sector is really not, generally speaking, investing a lot in agriculture. So the meta theme, I would say, of this webinar is how can we use the DCA to get this capital off the sidelines and invest it in agriculture and emerging markets. And so this financing gap is not spread evenly across agriculture generally. As you can see on this graph, there are a lot of finance providers for some of the bigger agribusinesses that need sort of $1 million or more, generally speaking. Most countries have a pretty well-developed microfinance. And then social lenders have entered, which are helping to fill some of the other financing needs. But there remains this big, what is called the missing middle of people, of agribusinesses that need, generally speaking, between $50,000 and a couple $100,000 in loans, and they have nowhere to go. And so this is what's called the missing middle in terms of investment size, where most of the intervention is needed. But at least in this webinar too, we want to have a more expansive definition of the missing middle. Because while it generally applies to the loan size needed, it really refers to segments of the market that just cannot get financing. So other reasons why agribusinesses can't get financing are maybe they're in a particular sector, poultry or dairy, that a bank just doesn't understand. So a dairy farmer needs a loan for a size that a bank normally provides, but the bank just doesn't work in that sector. Or maybe banks have, they stay away from agribusinesses with a low number of employees because they think they're high risk. Or maybe there's certain regions within a country that just banks don't operate in. Or the loan requirements of the agribusiness are different than what the bank provides. And so these are all essentially market failures that where agricultural finance interventions, as Sean mentioned, can play a very helpful role in correcting these market failures. And so the businesses that fall into these market failures, into this missing middle, are really a lot more than just farms. They span a whole value chain of actors. So everyone from the people who provide the seeds and inputs, to the farmers, to the people who retail it. And so all of these types of agribusinesses can fall into this missing middle. And one other important point about this slide is not only are there a range of different actors in agriculture, but this is a very highly dependent value chain. So a agribusiness that is facing a financing challenge will have a lot of upstream and downstream effects. So for example, say an aggregator has a financing challenge and can't grow, that obviously affects the aggregator business itself, but that has ramifications for processors and distributors and retailers. Even input suppliers and farmers, right? If that's the bottleneck on the chain. So there really is a ripple effect here for this financing challenge in agriculture. And so what do these agribusinesses need money for? Obviously, they use the money for a range of different things, but generally speaking, the money they need falls into two broad buckets. The first one is working capital, which is essentially a short-term capital. The most classic example is money in the cash register, right, which you need to transact, to pay your employees, to buy inventory. This is typically funded through the owners of themselves, through short-term debt, or trade credit, which is when somebody can deliver you a product and they say, pay me 30 days later, which is essentially a form of a loan. Then there's a second big bucket, which is the asset finance, which is really the bigger ticket items, generally speaking, which is the machinery that you need, the capital expenditures, the growth of the business, which is generally not only a bigger ticket size, but a longer payback period as well. And so why can't agribusinesses today get financing? There's a lot of reasons. There's two main reasons why: the market imperfections and borrower demographics. This is not an exhaustive list, but let me go through some of the biggest reasons that are out there. First, on the market imperfection side, a few financial products tailored for agribusinesses and producers. So the classic example here is, if you think about a typical loan, you get a loan and then you have to pay back a little bit every month with interest. But if you're a farmer and you don't have a harvest for 9 months, then obviously that schedule is not going to work for you. So there can be a mismatch between the finance providers, the products they offer, and what the farmers or agribusinesses need. High lending rates, as you know, the interest rates in emerging markets can be very high. And coupled with that, there are other opportunities that banks and other providers have that they perceive to be lower risk. They're not necessarily lower risk, but they perceive them to be lower risk. And then last, the risk-averse lenders lack experience in agriculture. When you get into agriculture, you have to know some of the value chains and some of the basics about poultry or dairy chain or whatever it is, and banks typically don't have this experience. And so as a result, they stay away. And on the other side, the borrower demographics, limited access to financial institutions. Obviously, a lot of agribusinesses are located in rural areas where there aren't a lot of bank presences, which makes it difficult. Poor non-existent credit history. There's not a reliable credit bureau or information from agribusinesses. Insufficient collateral, right? If a bank is risk averse, they want to secure their loan with some kind of fixed asset, and then obviously minimal bookkeeping. So these are some of the reasons why agribusinesses cannot get loans. And so this is where the DCA enters, which was designed specifically to directly address these challenges, which we'll get into in a moment. And so the goal, the DCA really has three really powerful effects when it's used well. Number one, it can unlock private lending for projects. By providing sort of support and correcting this market failure, you really get this capital off the sidelines and into specific agribusiness projects. Number two, the cycle of continued lending. This is really the point I mentioned earlier, is that the perceived risk is often a lot greater than the actual risk. So if you can coax or you can get a bank into the agribusiness sector by providing some kind of support. They learn about the market, they can see there's a viable opportunity, and then when another investment opportunity comes up again, they don't need a DCA support. And so this really starts kind of the virtuous cycle and corrects that market failure. And then guarantees multiply impact. I always found the statistic to be pretty powerful, that for every dollar spent on a DCA guarantee, you unlock $19 from the private sector. So it's not only unlocking private sector capital for specific projects, it's really just sort of industry-wide and mobilizing the massive amount of capital that is needed. Right? And so basically, how does a guarantee work? Megan is going to talk in a lot more detail about the specific kinds of guarantee products and how they work. But at a high level, if you think about the relationship between a bank and an agribusiness, the agribusiness provides a loan, and then the agribusiness either repays that loan with interest, or it can't repay the loan, and typically the bank gets nothing back, which is a big risk for the bank. And that's too much risk for the bank. And so what a guarantee generally does is provide an assurance or a guarantee to the bank that in the case that the lender defaults on the loan, they will be reimbursed for 50% of the loan amount. So instead of losing 100% of their loan, they will only lose 50% of the loan. And so this obviously changes the economics for the bank quite substantially, and is the incentive they need to kind of get involved, and where USAID plays a role. So at a high level, that's how it works. And so sometimes, so what is the DCA? So the DCA is really the legal tool that allows missions and to allocate funding to these private sector lenders to act as, just in case of default, to reimburse them. So as you know, there's not a DCA office within each mission, but the DCA can and should be integrated into mission programming worldwide. I'm sure a lot of you have experience working with the DCA, but we're having this webinar in part because we believe there's a lot more potential. DCA can be used a lot more. So it was specifically created to get this capital off the sidelines, to mobilize commercial debt, and to correct these market failures. And so these guarantees, the DCA guarantees, sometimes get confused against grants and contracts. I won't go through every line on the slide. We will make these slides available after this webinar, so you can review them. But in general, the guarantee, as we just talked about, is reimbursing a bank in the case of a default. Grants, in contrast, are payments that don't need to be paid back, that can be used for public purposes, social, to demonstrate the feasibility of something for a social purpose, and comes with all kinds of conditionality. And then the contract obviously is directly between USAID and awardee, which is where there's a contractual obligation and regular payments where there's a higher level of control than the other two. But they're three very different products. And just one other point on the next slide between guarantees and grants is just on the design timelines, just something I wanted to highlight here, which we'll also talk about later. Is guarantees generally take 6 to 12 months. Grants and contracts are a little bit shorter, and contracts are a little bit longer. Obviously, they're all tools that missions can use in their development programming, but all very different. And I just wanted to wrap up this section by talking about, the DCA is not a conceptual solution when it comes to agriculture. The impact has been very large so far. I mean, in agriculture, the DCA has unlocked almost $2 billion US dollars of private sector capital, which is nearly a third of its portfolio. So these are big numbers, but again, they can be a lot bigger. And in terms of the number of guarantees, almost half of the number of guarantees by quantity are in agriculture. And very interestingly, too, that 2/3 of the borrowers of the portfolio are in agriculture. So you can really see that $1 unlocked has a much disproportionately higher impact in agriculture, just because it's a big sector, there's a lot of people, and the money can go a long way. And so this wraps up the why section, but before turning it over to Megan, let me pause here and ask if there's any questions or comments up until this point. And if not, you can ask questions now, or we can save them for the end, where we'll have a Q&A session at the end as well. Okay, well, if not, I'll turn it over to you, Megan, for section 2.
Great, thanks, Mark. So the next section here talks about, what are the guarantee principles and when does it make sense to use a DCA? Principles that drive how and when we use the guarantee. But I think it's important, as Mark mentioned, that the guarantee is just a tool. It's like a grant or a contract, similar to other tools that the mission has. The guarantees are by mission, so they're mission led, they're demand driven. We're not a standalone program. We're a tool, and we're designed to help support a specific operating unit to achieve a specific development. And so at the end of the day, they're all about finding what are the development goals, what's the impact we're trying to achieve, and designing a tool that hopefully addresses that. What we're also going to talk about later is the complementarity issue. The guarantees are, in the best case scenario, they're designed in partnership with a lot of other programs and tools, and in the context of the mission strategy, so that they support the other tools and other programs that are going on. Another big part of our core principle is that we want to see continued lending after the guarantee is done. So we want to see that bank, after 5 years, 7 years, 10 years of a guarantee agreement, we want to see that they have increased their comfort and they've increased their experience and they're able to lend without the guarantee after that agreement ends. And so this is an important thing, especially for missions who are considering multiple guarantees through the life of their portfolio. We always want to see that if we're working with the same banks or similar banks, that we're really pushing that market and continuing to take risks and go further. This concept of additionality, when we say additionality, we mean there's something happening here that wouldn't happen without the guarantee. So whether it's a longer loan duration, whether it's just purely that borrower would have never got a loan without the guarantee and now they can get a loan with the guarantee, maybe it's a better interest rate, something is happening that would have not happened without the guarantee. And then the last kind of a core principle for ours, which is really different than a grant or a contract, is that we want to see and actually need to see risk sharing with that bank. USAID is not the lender. We don't give any money to the banks and we don't give any money to the borrowers up front. The bank is lending its own capital, and so we want to see them take some risks. That's the whole point of why we do this, is we want that bank to take some risk, not all the risks they would have taken, but some risks so that they can make smart lending decisions. And then once the guarantee is done, they will hopefully have more comfort with that risk. And this, I think, is interesting. There's quite a few times when we do the guarantee, but we pulled out these 4 situations because these are some of the most common ones that we find in the agriculture sector. The first situation there is kind of what I just piggybacked off at the end there. It's too risky. The bank maybe looks at the sector and just says they just can't do it. It looks at the business. We had a company in the Ivory Coast, was a cashew processor. It was a new company, new project, and the bank just couldn't get comfortable with it as is. And so it was just a classic. There's too much risk. We can't get involved. Second one, a little bit more nuanced, is what we call this kind of information asymmetry, where there's information that the borrowers have that the banks don't have. And so in Cambodia, the banks really struggle with understanding the growing season, the challenges, the risks. They just don't have enough data to know, am I making a good lending decision or not? They have a challenge, assessing, will this business pay me back, and basing that on something. The third situation there that we see is, where we've done the calculation, or maybe the program that the mission has, or the mission has, the State Department has, and says, there is a really strong chance that this borrower is going to pay back their loan. I mean, this is a really low projected default rate. There's a very rare chance that it's going to default. However, these banks just won't move into that. And so we see this in a lot of cases in agriculture where there's a lot of really good, off-taker agreements, so there's other risk mitigation, packages put in place. But even with that, the bank is not comfortable because they need that experience. And then the last thing, which is also really common in agriculture, is when the loans just, even if all the financials look good, if all the numbers line up, the bank just isn't going to do it. There's just absolutely no chance that they would lend without a guarantee. So we saw this in the strawberry sector in Kosovo, and we're going to talk about a couple examples where this has happened as well in the examples we're going to give. But these are just some of the situations that come up in the agriculture sector, and some examples of things that missions have done to try to address those challenges. The next section here is going to be on what are the specific products. And so we've got 5 core products. You can go to the next slide there. We've got 5 core products. We've got a loan guarantee, portable guarantee, a portfolio guarantee for loans, a portfolio guarantee for leases, and a bond guarantee. And so in the next few slides, I'm going to go through what each of those tools are and an example of them. They're all DCAs. All 5 of these are DCA guarantees, but they're all 5 different structures. So the first one, a loan guarantee, this is really similar to how Mark talked about what a guarantee is. This is where we know upfront who the lender is, and we know upfront who the borrower is. And we negotiate and sign a legal agreement that lays out the terms of what that lender is going to do, who the borrower is, and how, in case of default, we are going to play a role. As all of our guarantees are, typically they're 50% risk-sharing agreements. We can go as high as 80% equal risk sharing. So we don't do first loss guarantees, meaning that if a loan defaults, if $10 default, the bank loses 5 and we lose 5. If $20 default, they lose 10, we lose 10. So equally, all along the way, we're losing money. And so that's what an equal risk-sharing partnership looks like. And so the next slide there is the example. This is an interesting company, Verde Beef. Verde Beef is a meat processor in Ethiopia, and what's interesting about them is they were a borrower underneath a previous loan portfolio guarantee in Ethiopia a few years ago, and came back and said, we got a loan from this bank, but we need a larger loan, we need more specialized loan capital, and the lenders we can't get a loan. And so Verde Beef worked with the mission locally, and we structured what a loan guarantee would look like with a local bank called Zemin Bank. And Verde Beef was a direct loan from Zemin to Verde. We said that if in case of default, we would pay out 50% of any defaults that came from that loan. And yeah, we're in the middle of this. It's still in process, but Verde Beef is in the middle of building a new facility, increasing jobs, increasing exports, creating a market for farmers to sell their cattle locally, which is pretty neat. We talk about the agriculture value chain and how markets are needed at all different levels of this. This is a great example of a guarantee helping create a market. You're in essence the mission in Ethiopia created a really outstanding market for cattle locally, which adds to jobs and adds to livelihoods and helps value chain, a complete chain and not just a siloed piece. The next example we have there, I think, is a portable guarantee. But the difference is we know upfront who the borrower is. We found a borrower, we've identified the borrower, but we don't know who the lender is going to be. And so USAID would actually sign what's called a portable guarantee, which is in essence a commitment letter. It's actually an obligating document, but it's a letter of commitment that we would sign with the borrower saying, once you find a letter, we will then convert this to a loan guarantee. this is a tool that we have. We don't use it a lot though, and part of the reasons why missions don't like to use it is it can double the time it takes for the borrower to get their loan. Because imagine if we find a borrower, it takes, as Mark mentioned, the design phase is 6 to 12 months. It takes 6 to 12 months to design and negotiate the guarantee agreement with the borrower. The mission obligates it, but then now the mission or the borrower has to basically start over or go back and now take that obligating document, the legal agreement, and try to find a lender. And then we do the loan guarantee. So then that's another 6 to 12 months. And so what we really prefer is if there's a case where we found an agribusiness that needed a loan, that we would provide some type of non-binding letter of intent to that agribusiness, let them use that to shop around, which there's no design timeline for that because there's no obligating funds as a part of that agreement or part of that letter. And then once they find the lender, then we would just go ahead and do a loan guarantee with that lender. We would kind of cut a lot of the bureaucracy and a lot of the process out. However, that said, there are times when we do portable guarantees for very specific targeted reasons. And so the next slide there talks about one of those times. It was with a company in Morocco called Fuyo Puerto. And what's interesting about this one is, this is a really risky deal for multiple reasons. It was a greenfield company, meaning a brand new company, as well as a greenfield facility. They had no experience building the facility, and they needed financing to construct it, to actually build this facility out. And the local lenders just thought it was way too risky. The vision is to build the facility on the port, on the Tangiers port, that would allow import and export of horticultural products in Morocco. And they just were, the lenders, wouldn't take it seriously and needed to see that legally binding portable guarantee agreement with the U.S. mission in Morocco in order to get comfortable. It's a pretty amazing story. They've now built this new facility, created new jobs, increased cold chain storage for the region, and really given local horticulture a chance at exports, which is a pretty amazing story. This company is really quite an interesting company, and there's a lot of potential here. And they've had a lot of challenges and have really persevered through a lot. But this is a great example of really targeted approach that the mission wanted to really focus a lot of efforts on in order to address this cold storage issue on the ports. Next example here is a loan portfolio guarantee. This is where we work with a lender, and we have a lot of borrowers that we know are going to be under the guarantee, but we don't know who all those borrowers are at signing. We hopefully know who's in the immediate pipeline. We hopefully know in the next 3 to 6 months who some of those borrowers are going to be, because we've been talking to the bank. But we just sign a legal agreement with the lender, and we agree up front who we want that lender to lend to. So maybe we want them lending to agribusinesses in a certain region. Maybe we want them lending for a certain value chain. Maybe it's a trade deal, and we want them focused on agricultural exports. Maybe we just say agriculture in general. So there's so many ways that missions structure these. This is our most common guarantee structure for agriculture, probably for most of our sectors, but for agriculture certainly. And part of that reason is a lot of times the USAID missions are targeting smaller agribusinesses. And so having a portfolio guarantee allows them to do that. As you may have noticed in the previous two examples, the loan guarantee and the portable guarantees are for much larger loan sizes. So this is, when Mark was talking about the missing middle, oftentimes the missing middle is that $50,000 to $200,000 loan ranges. And so that's usually where a portfolio guarantee comes to play. The next slide there is going to show you the example here. This is in Cambodia. This is an extremely interesting guarantee. The Cambodia mission has taken a very intentional look at how to mobilize finance for agriculture. And we actually the mission signed a guarantee back in, I believe it was 2012, with a small microfinance institution that was a really, really successful agreement. No defaults, a lot of disbursements. And so the mission decided, okay, given that experience, let's try to push the market a bit. And so they wanted to go and structure a new agreement and decided they wanted to work with multiple lenders. This is a unique approach where they said, we want 3 microfinance lenders and a leasing company to come on board and to enter into what's called a multi-bank or a multi-party guarantee agreement. And those 3 entities would be lending to agricultural entities in the Feed the Future regions. And so this was interesting because the mission there are all to promote leasing. And so those 2 companies, E and AMK, are both more on the microfinance side. And what the mission wanted was for those entities to start thinking a little bit larger. And can we go up the value chain a bit? Can we help those microfinance institutions lend a little bit larger loans and keep expanding and diversifying the agriculture sector? BSP Finance, on the other hand, is a leasing company, and they are actually the sole lessor of John Deere tractors in Cambodia. And so this is an interesting one because we wanted BSP to start looking at tractor finance and working capital loans a little bit smaller. So it's an interesting deal in that we wanted to promote some larger loans, some smaller leases, focusing on Feed the Future value chains and regions. It's the guarantee. It was just signed, so it's only, I don't know, a year and a half or so into it. So, but it's pretty impressive. There's been a tremendous amount of disbursement so far. No defaults. This one is also an interesting structure in that at least half of the portfolio must be for women in the agriculture sector. So the mission really took a very forward-leaning approach with this one, both looking at diversifying, different types of loans and leases underneath the agreement, bringing in a diverse range of partners, as well as focusing on women entrepreneurs. So a really interesting structure here. The next slide is the lease portfolio guarantee. This one is almost exactly the same as the loan portfolio guarantee, with the only difference that there's a financial institution, a leasing company, who is giving out capital or finance leases. We can't do operating leases, which is like a rental agreement. Like if you were to go rent a car, that's an operating lease. We can't guarantee a rent, but we can guarantee kind of what you would think of as a lease to own structure, a capital lease or a finance lease. And so this is extremely interesting for the agriculture sector, especially when you look at tractors or implements off the back of a tractor, or maybe leasing processing equipment or irrigation equipment. It's a really powerful tool. But it's structured the same way as a loan portfolio guarantee, where we sign a legal agreement up front with the leasing company, with the financial institution. They're then providing financed capital leases to agriculture borrowers, or lessees is what we call them. And then if those lessees don't pay their lease payments or default on their obligation, that's when the DCA guarantee kicks in. And so the next example you'll see there is with a leasing company in Senegal called Locafrique. The mission in Senegal has also taken an extremely interesting, innovative approach to agriculture finance, and signed an agreement with the leasing company. I believe this was in 2016, I think is when this one was signed, 2015. And this is a part of the almost $6 million guarantee. And what's interesting about this one is, at the time, the mission didn't have a tremendous amount of budget to do a guarantee. And so they actually convinced the local Senegalese Ministry of Finance and Economics, as well as the Italian Development Corporation, to pay for the cost of the guarantee for the mission, which is pretty exciting to see. That's actually the first time ever that an African government has paid for the cost of a USAID guarantee. So props to Senegal for that. But so when Mark was talking about leverage, this is, an infinite leverage, right? Because it didn't cost them anything, but I suppose besides their time. But But anyway, so this was really interesting. It was the Loc-Afrique was a company that was predominantly interested in automobile leases, and said that they weren't as interested in expanding into agriculture without some type of risk mitigant. And so that's what the USAID mission did there. Is they said, all right, well, we will guarantee those leases if you will expand into the agriculture sector and if you will finance tractors. This was really focused on tractor finance. It was very successful. It was 89 leases were committed. There were some defaults, which actually I think is really interesting about this one. There were 18 defaults, and I actually I think that's not necessarily a bad thing, because that shows us that Loc-Afrique really was taking risks, trying things that they didn't know about, learning the market, making mistakes. And yeah, so I don't think that's necessarily a bad thing. That's why I wanted to put that here. And we actually, the mission now has a new guarantee with Loc-Afrique they signed last year, which is quite interesting as well, focusing on post-harvest equipment. So not tractors, but trying to help Loc-Afrique move to more sophisticated equipment. And the last example is the bond guarantee. This is where there's an entity, whether it's an agricultural business, whether it's a financial institution that lends to agriculture, but an entity that needs maybe longer term capital or local currency capital. And so they actually issue what's called a bond, which is basically a loan. And then there's investors that purchase that bond. They're basically, the investors are lending money to that entity. And then in case of default, the guarantee would pay back the investors. So it's this exact same structure as a loan. I know bonds sometimes can sound more complicated than they are, but it's the same structure of a loan. The only difference is the bondholders are in essence the bank, right? The bondholders are the investors. They're the lenders. They lend to the entity issuing the bond, and then the issuer of the bond pays the bondholders back. And so when the DCA guarantee interacts with the bond, with the bond guarantee agreement, we need to sign the agreement with what's called an agent or a trustee, but some entity that's acting on behalf of the bondholders. Similar to how we sign an agreement with one bank for a loan portfolio guarantee, or maybe 3 banks. But for us, if somebody's issuing a bond, and if there's going to be hundreds or even dozens of bondholders are going to purchase that bond, maybe they're going to trade it, maybe there's going to be secondary trading on that issuance. And so we aren't able to then know who are all the bondholders if there's a default and pay 100 separate individual wire transfers. And so that's what that agent is there. There's somebody that sits in the middle that acts on behalf of the bondholders. We've got a question there from Anna. If you don't, I'll go ahead and take it, Anna. So this is a great question. She says, are there private investments in these bonds? Somebody like a John Deere or a Monsanto or a Cargill? That's a great question. Typically, the investors in a bond would be something like an insurance company or a financial institution, or maybe a high net worth individual, maybe a pension fund. Usually purchasers of bonds, similar to in the United States, if you purchase a municipal bond, typically you as an investor, you're not purchasing as a company. John Deere, Monsanto, Cargill, if they have pension funds, which I'm sure they do, for their employees, those funds may be investing in bonds, so indirectly. And so they're certainly private investors, but typically you're not going to see John Deere purchasing, a bond in Senegal, for example. You would see companies like that on the equipment side or on the seed side for Monsanto, for example. And then the question on how do you attract bondholders? That's an outstanding question as well, because that's, we could do a whole training just on structuring bond guarantees and how it works. But one of the main things to know is before, designing a bond guarantee, there's some things that the country needs to have in place in order for it to work. One of which is a functioning capital market. Another of which is potential investors. And so sometimes we see missions that, maybe they have a program before we go and do a bond guarantee where they're working together to get these potential investors interested. So the example here on the bond guarantee is in Armenia. And this is an interesting structure. In Armenia, there's this group called the Universal Credit Unions, UCOs, who are unable to accept deposits. They lend to agriculture sector, to agribusinesses, they lend to rural entrepreneurs, but they have a hard time getting funding to make loans because they are not a deposit-taking institution. And so what's interesting here is while they have all these loans on their balance sheet, what they decided to do was to package those loans, sell those loans to what's called a special purpose vehicle, an SPV. That entity bought those loans. That's called a securitization. When you buy the loans or the debts off of somebody else's balance sheet, now you own them. The SPV packaged those loans and then issued a bond in order to raise capital. Really interesting structure. This was Armenia's first ever securitization of microfinance loans. It's a very powerful tool. It's a great way to help microfinance institutions, or in Armenia's case, UCOs, access capital that they wouldn't ordinarily have, so that they can then on-lend to the agriculture sector. So $5 million in funding was made available to these small businesses. About 70% of those were agriculture loans, which is pretty powerful. This also opens up a more sophisticated financial market so that other entities could consider doing a similar structure.
Megan?
Yeah.
Megan, actually, I'm calling from Armenia. I just want to say thank you very much for bringing this example of a microfinance securitized loans. Yeah,
you're welcome.
Thank you very much.
Oh, yeah, you're welcome. Yeah, this is, I'm sure this won an award a couple of years ago for the most innovative deal of the year. So congratulations. Yeah, this is really ahead of its time and an extremely creative way to look at agriculture finance. So good work on this one, that's for sure.
Thank you very much. And I just want to mention, Megan, that going back to this investors or how you're placing the bonds. I mean, in our case, this was the purpose was twofold, basically to make the capital or loan capital available to rural enterprises, but at the same time also issue the bond that could serve as an instrument for the pension funds to be, so pension asset managers just to invest their contractual savings. So we were trying to sort of solve twofold problems.
Yeah,
there.
Exactly.
That's it.
Yeah, no, it's amazing.
Mm-hmm.
Yeah, I mean, we talk about this a lot. Is what do you do with that local pension capital? And you're exactly right. You guys were tackling both sides of the development challenge with this one.
Yeah. Mm-hmm. Thank you.
Great. So the next slide, this is kind of a summary of these slides. I think this is helpful just to kind of take a step back and look at them. But I'm not going to go through this again because we've talked about it. But I think the big takeaway here from my perspective is in the agriculture space, there are so many ways to use the guarantee agreement, and there's so many different, just as we just heard from Armenia, creative approaches. And I think for me, I think about what we always want to start with is what is the development challenge, as Mark talked about, what is that market failure we're trying to address? And then the mission designing, and we help you with this, a tool, a product, a guarantee structure that addresses that issue. You can go to the next slide. Great. This is a good segue here. So the best practice for our guarantees worldwide are for them to be designed, in the context of a program, a mission program or a mission strategy, and ideally in combination with other tools that the mission is managing. One of which there could be a grant. Perhaps there's a grant in place beforehand to prove the business viability of the business. Perhaps a grant is used to fund a technical assistance for to train the lender. next one, technical assistance. Perhaps there's a program in place side by side with the guarantee that's either working with the lender directly, working with the borrowers directly, or perhaps a combination, or perhaps acting as a matchmaker, or perhaps acting as a market force. The third tool that we have clearly is policy advocacy. This is extremely important, especially if you're looking at something like a bond guarantee, or maybe you're looking at, an export deal and there's really high VAT taxes, for example, or there's challenges in bureaucracy with exports. So there's some great policy advocating that. Another thing that's mentioned there is on collateral. We could do a whole separate training on bank regulations, but one thing sometimes we see is that banks are required to have such high collateral percentages on their books by their central banks that it makes it almost prohibitive to lend to something like the agriculture sector. And so there may be countries where USAID can act as a policy advocate to help think through, are there changes that central banking policies could make that would affect the agriculture sector. And then the last bucket there on convening power, USAID has an amazing ability to pull all different types of people together and to find common shared interest. And I think this can't be overlooked. I've seen so many missions do some really amazing projects where they're just the one, bringing everybody around the table and getting everybody on the same page. So I think that can be a really, really powerful tool. You can go to the next slide. So this is an interesting example of some of those different tools, although I could name dozens and dozens of missions I've worked with who have done this really successfully. But the one that we flagged here is in Mozambique. Mozambique agriculture is a huge part of their GDP, a large part of the employment. It's very vulnerable, a lot of challenges, low productivity, low income. Banks are very hesitant to lend to the agriculture sector. They consider it very risky, and they need collateral. They need really strong collateral in order to get comfortable lending to the agriculture sector. There was a couple banks, Banco or Opportunity Bank and Banco Terra. Both of those banks were interested in lending to the agriculture sector. However, they just couldn't do it. They couldn't get comfortable with the risk. And at the same time, Swedish SIDA, the development organization, was also interested in supporting agriculture, but wasn't sure exactly how. So you can go to the next slide. So a couple questions that that we asked here is, what were the barriers to financial access for the agriculture sector, and what are some tools that USAID has to reduce these barriers, and how can other partners be engaged to make a more scalable impact? These are some of the things that we were kind of thinking through. So we've got the Mo's Ag Loan Portfolio Guarantee. The other thing that's interesting, I was talking with my coworker, Jesse Karate, yesterday, who supports Mozambique, and he couldn't stop talking about how, this slide is just one piece of what Mozambique is as a mission is doing, and explaining that, Mozambique kind of take larger portfolio look at agriculture finance, and when they design their guarantees and their programs, they are really looking at how do we attack different parts of the value chain, and how do we look at it as one partner can have one role, another partner can have another role to play. And so this is interesting. We did a guarantee with Banco Oportunidad. I believe this was in 2010, we did this guarantee in 2010 with Banco Oportunidad. It was very successful. I think actually these numbers they're a little bit higher now. This evaluation was done in 2015, but the guarantee kept going. So I think it's about $2 million that have been dispersed from Banco Oportunidad. And so the mission was testing the market here, wanted to see how it was going to go. And as a result of that, they saw that a lot of these borrowers were first-time borrowers. A lot were women. 25% were women. 70% were first-time. They had a really strong technical assistance program in place to support the agricultural MSMEs. And then afterwards, SIDA and Banco Terra wanted to come on board and do a new facility to kind of even push the market even further. CETA and USAID, I believe, cost shared or in the process of determining how to cost share for technical assistance as well as an evaluation. So really neat to see how a lot of tools coming together, different partners having different comparative advantages to play, looking at how do you bring technical assistance into the map, and then also looking at how do you keep pushing the market. I think I've got a question here in the chat box. I'm going to look over here from Bill Thomas. Bill says, what's the mechanism to ensure the loan is not used for something which results in a significant negative environment impact? For example, to purchase banned and highly toxic pesticides. If an event were to happen and farmers or their families were impacted, would USAID be liable? Great question, Bill. So I don't know if you remember, if you were here at the beginning, Mark went through the difference between guarantees, grants, and contracts. And just like a grant or a contract, the mission does an IEE, an initial environmental examination before obligating the guarantee agreement. And as a part of that, we look at, are there any extraordinary environmental issues that we should take into account? And so what happens is the USAID legal agreement, the guarantee agreement, already has a pretty strong section in the legal agreement for environmental activities. So the guarantee agreement's about 40 pages long, and a couple pages of that is what are like the prohibitive activities that the bank cannot do. And one of those categories is all focused on environment, and pesticides is included in there, large-scale agricultural digging is included in there. There's quite a few things in there that the bank is prohibited to do. And so what would happen is if the bank does any of those things, the guarantee would be null and void. We would not be liable at all. We would not pay back that loan because that would be a breach of contract. The bank would have breached the contract of the agreement. That's why it's really important when missions are designing the guarantees to look through the legal agreement, and if there are additional things that might be country specific, the mission needs to integrate that into the legal agreement in the design phase when we're negotiating. Because once we sign that legally binding guarantee agreement, not like a grant or a contract, go back to the bank and say, hey, do this, don't do this, because we've already signed that legal agreement. So big takeaways: IEs are required for every type of tool, including the DCA guarantee agreement. Other takeaway is there are environmental activities that are prohibited that are already in the template guarantee legal agreement. And the other big takeaway is if the bank breaches any to those activities, they're not, well, the guarantee is null and void. And then the final takeaway is if there are specific things that are not included in that guarantee legal agreement that the mission wants to make sure are protected against, then they would want to go ahead and integrate that into the guarantee agreement before it's signed. So I hope that answers your questions, Bill. It's a great question. Really appreciate that. We also had a question about OPIC, about DCA and OPIC finance. Yeah, we've done a couple deals where we work together with OPIC. We've done some in Haiti. We've looked at some, I believe, in Tanzania, I think. But it's interesting. We do quarterly pipeline review meetings with OPIC. We've done that for many, many years now, and we actually don't find that there's a ton of overlap. We tend to be on the much smaller micro size, whereas they're in a little bit of a larger playing field than we are. But yeah, we certainly have worked with them in the past. We talk with them regularly, and we've done some deals. I think the Tanzania deal, if I remember correctly, it was maybe a couple years ago, and they were guaranteeing some banks in one region of Tanzania, and we were guaranteeing some banks in the Sagcot, different region of Tanzania, if I remember correctly. So yeah, that's just one example, but I'm sure there's others out there. Good. So the next slide here is, how do we think about guarantees, some best practices? one thing I go back to all the time is, what is the development challenge? What are the challenges that the borrower is facing, and what are we trying to address? Whether that is through I've come to missions and said, listen, the challenge you're trying to address, the guarantee is not going to be your tool. You need a different tool. But I think that's always the first step, is what's the challenge? What are we trying to address? And then we apply either the guarantee tool or multiple tools with that. We're going to talk about this later, but the cost of the DCA guarantee comes from mission budgets. So that's one thing. We'll come back to that later. We want to document our development goals clearly up front. This is really important because sometimes, if a foreign service officer leaves, or an FSN leaves, or people in my office leave, and the guarantee is 10 years long or 7 years long, sometimes it's hard to remember, well, what was the goal of this thing when we signed it in 2008, And so it's really important to make sure that we all are on the same page about what is the goal of the guarantee, why are we doing it, and that our partners are aware of that. The other thing we talked about a little bit, bond guarantees take a tremendous amount of time, can be insanely impactful, and very market moving, but important to make sure that the conditions are right and that the mission has sufficient staff to support something like that. And then the last kind of thing to think about is, we can target the borrower as well as the lender. So there's different ways to approach designing a guarantee. Great. And so the next section here is on designing and implementing the guarantee. So we'll kind of go back and get into that cost of the guarantee. So you can go to the next slide. So so the design phase, about 6 to 12 months, as we've said, although a bond guarantee can take much longer. I worked on a bond in Senegal that took us, maybe 2 years to design, and the bond actually didn't even launch. So those can be very, very, very time intensive, but it takes about 6 to 12 months. And then the implementation phase, meaning how long the guarantee is active, can be as long as 20 years. But typically we find that missions will do 5 to 7 year agreements. So if you look at how do you design, generating the ideas, what is that development challenge you're tackling, and what are some ideas of how to do that? We then negotiate the deal with the financial partner. This is where your RLO, your regional legal officer at the mission, your lawyer, is insanely instrumental. This is where they come on board. We complete a risk assessment. This is the part of the process where we actually determine what is the cost of the guarantee based on how risky is it? What are the risk factors that we need to take into account? And so therefore, how much do we think is going to default? And therefore, how much do we need to set aside in the Treasury Department? And this is a service that our office does to help missions. We will actually come and help you do that. We then, the mission and the DCA analyst, present the deal to our credit review board. USAID has an internal board that determines we provisioned appropriately for our guarantees. There are a risk review committee. We then finalize the legal agreement, step the obligating. So once the guarantee is obligated. During implementation phase, we monitoring the mission leads and supporting disbursements and impact with support from our office. Our team will help if there's a claim to pay out claims in cases of default. And then the final part is to evaluate the impacts. Did it achieve the impacts that we set out to achieve? Not subsidizing anybody. We're not giving anybody money. Governments where we transfer money, USAID, to the Treasury Department. So actually no money leaves the US government unless there's a default. And so the main source of funding for the guarantee is USAID. That's part of our budget. The program budget at missions is most likely what pays for most of the guarantee subsidy costs. The mission is subsidizing the cost of that guarantee. Agency, we are the ones that provide the funding for that. It's usually a bilateral mission or maybe a regional mission. It could also be a Washington unit. Maybe there's like the gender office, I believe, has helped support some guarantees out there. BFS, Pat has done some interesting structures out of his budget, but it's a USAID operating unit. It's who pays for that guarantee. The second part of the cost is paid in fees by the financial partner. I've seen, it's been on slides, I haven't really mentioned it, but the financial partners are paying us fees to access the AAA U.S. Treasury backed guarantee. And so that money goes to Treasury as a provision. And then the third area that the payment could come from is a gift funder. So USAID, Senegal, as I mentioned, got money from the government of Senegal. The Gates Foundation has paid for guarantees. DFID, the UK development organization, has paid for guarantees. Private companies can pay for guarantees. So we have the ability to accept gift funds. So it can also come from one of those sources. And the other interesting thing here, I think this is really important, is, okay, so up front, USAID pays for the cost of the guarantee. So that's USAID, bank fees, and possibly a gift funder. We pay for that up front, similar to a health insurance or a life insurance policy where you pay some premium, you pay some amount. In this case, it goes to the Treasury Department. We have an account at Treasury, which is where all of the provisions from all of our guarantees globally sit. And then if there's a default, our team and then usually the controller at the mission will help get the wire transferred to that lender. But what's important to know here is that if there's a default, the USAID mission does not have to go back and find additional program funds to pay out that default. That money will come from Treasury. Even if let's say it's a $10 million guarantee agreement and the mission has provisioned $100,000, and let's say the whole thing collapses. Let's say all $10 million goes bad and $5 million is what's owed to the bank. The mission doesn't need to go back and find $490,000. That will come from the Treasury Department's account. And so that's really important to know. We get that question a lot. That once the mission has paid for the guarantee up front, has provisioned for it, if a default happens, they don't need to go back and get more money. There are times, though, when we might modify or change a legal agreement, and maybe there is more money needed for that, but that's a different situation. Good. This is interesting. I like to think about, legally, what can we do? What can't we do? What are some things we might want to try? Can we work with the sovereigns? It's part of how we operate, because we want to stimulate private commercial capital. And so we are unable to guarantee, a sovereign state-owned bank. We can't do non-commercial debt similarly. However, we can work with parastatals. This is interesting. We can work with sub-sovereigns and parastatals. So we can work with a parastatal utility company, for example. We can work with a sub-sovereign, maybe a municipality that's out in the rural area, or maybe it's a group of states within a government or within a country that are trying to do a project. So we can work on the sub-sovereign level, but not with the sovereign government. We can work with funds so long as they're debt funds. We can't do equity, but we can do debt funds. Can we do impact investors? Yep, we can do impact investors. Same thing, as we're not guaranteeing equity. The last one, can we issue direct loans? This is a fun fact. Legally, we are allowed to issue direct loans as an entity, but we've never done it in the past, and it's been a policy decision that, number one, we don't have the capability to be a bank right this moment. But number two, we've actually never had a circumstance where we couldn't find a commercial lender to lend. We've always been able to find a lender that wanted to put capital up, and we would act as their guarantor. So we've never actually felt the need to have the ability to provide direct loans. But I think it's interesting because we do have that legal authority. Great. So this is, yeah, some best practices. Yeah, this is good. So I think we've got some best practices on designing guarantees and some best practices on implementing guarantees. So on designing guarantees, we've got kind of three buckets. One is on mission, people, and programs, this one here. In designing the guarantee in that 6 to 12 months period, it's really important to make sure that there are people that are able to support the negotiating, the due diligence. It's a ton of work. It's a lot of work. There's a lot of stuff goes into this process. So we want to make sure we've got mission and DCA staff time ready to go. Second part there is, as I mentioned, your RLO is a very key negotiator with the term sheet and the legal agreement. Another really important thing to do, we've talked about combining different tools, and this is a part of it, thinking about, are there other programs, are there other technical assistance goals, are there other needs, what else is going on in the market, why access to finance isn't moving for that part of the agriculture sector, and maybe we need to map out the needs of those borrowers and make sure that we've got the right thing in place. Maybe there's bank training needed. What are the challenges, and then how are we addressing those? And the last thing, we want to make sure that our program officers and our M&E specialists are engaged, because we do want to make sure that we're tracking, is this thing working? Like, is this having the impacts that we wanted? And so it's really important up front when designing the guarantees to ask those questions and set us up so that we can find out, how did it go. The next slide there is on structuring the guarantee. We can do our guarantees in dollar as well as in local dollar or local currency denominations. However, what's important is how that borrower is getting paid, right? What the borrower's main business activities are in. That's what they're getting a loan out, and that's what our guarantee is. And so what we don't want to see is currency mismatches, because that can end up in a lot of risks for the borrower, which is not what we want. Another big thing with signing guarantees that comes up in the agriculture sector a lot is on revolving loans. A lot of banks do revolving loans for agriculture and for other types of businesses. And what's really important is when designing the guarantee to talk to the bank about that and to find out, are they planning on doing revolvers? If so, we will need to bring in our compliance team to talk about, okay, if that's the plan, how are we going to integrate that into the legal agreement? How are they going to report to us on that? And because we are unable to do a revolving line of credit often as the bank is doing it. And so we need to know that in the design phase so that we can appropriately take care of that. And then the last thing is, making sure that the lender has enough skin in the game. The whole purpose, going back to, is we want them to take some risks so that they can then keep doing this without us. And so sometimes in the design phase, it can get tempting to take on more of the risks than we probably should. But it's really good to take a step back and say, no, we want to make sure that that lender does have some capital at risk, does have some serious, potential losses that would be, obviously not good for them, because we want them to be making good credit decisions. Front, what's the goal? Why are we doing this? Documenting that baseline data. Our team can help you with that. We've helped a lot of missions think this through, and then communicating those goals to the partner. What are we trying to do here together? And does the bank know that? This guarantees are so different than a grant and contract that way, right? Because in a grant and contract, the implementing partner is, sending us quarterly impact reports. That is not how the banks work. The banks are not going to be sending us quarterly impact reports. And so it's really important to be clear with them that, hey, here's why we're doing this guarantee agreement. Here's what our goals were, and have a conversation about, realistically, what can we figure out together of how to track the impacts. We love to highlight borrower impact. That's why we're doing this, is to get loans out the door to support borrowers. And so letting the impacts, there's a lot of really creative ways that we can do that. And missions have been able to do that, whether through videos or visual stories or even cables or press releases. And so thinking about how can we showcase the impacts of those borrowers in an appropriate way. And then the last thing, obviously, is then at the end of the guarantee, look back and reflect data to see what can we do this time. Implement missions need that is responsible and that as well. Quarterly checking relationship and meet people is we found a really great overall for be actively disengage if there's trouble. You can engage when things are going well, doing check-ins, and remembering that the bank is not our implementing partner. They're not a grantee or somebody that we give a contract to. We're actually the equal risk-sharing partners in this agreement, and so it's a very different kind of relationship, and often need a lot more back and forth. Another thing we find in a lot of our banks is that similar to some missions, sometimes there can be high turnover at the bank. What we recommend is at least annually, depending on the bank, having refresher trainings on the guarantee terms, on the process, on reporting, on what the goal, because just as if it comes into the mission, there might be a new person at the bank that doesn't necessarily know that there's a guarantee or that the status of it. And then the last one there, implementing guarantees, is it's really important to have multiple different touch points or touch points at the bank. It could be with the credit analyst, could be with the branch managers, could be with the head of credit, bank management, about among the decision makers are up and down looking at all different decision makers and having the right kinds of touch points and contacts with those people. Turn it back to Mark, but if anybody has any questions on those sections, I think there were some questions in the chat box, but feel free to type any questions or shout them out if anybody has any questions. So
yeah, thanks very much, Megan. And we'll maybe just pause for a few minutes just in case people do have questions that they want to type in or shout out before we move into a slightly more interactive session where I'm saying we're going to apply some of these principles. So I'll just pause here for just a minute. All right, hearing none for the moment, why don't we plow ahead? But again, do feel free to use the chat function or just jump in with additional questions. So one thing we wanted to do was just kind of think about, okay, we've gone through now kind of what the DCA is. We talked a little bit about why different tools that exist under DCA. I wanted to spend a bit of time seeing if we can apply it to a potential case study. And so what we'll do is we'll pause. Actually, there's 3 sub questions. And we'll just pause, and if you can either jump in with a thought or if you just want to type out some notes on the chat window, that'd be great, and then we can kind of move through the next phase of this case study. But in this kind of fictional case study, it's a farmer cooperatives in the small agrarian Sylvania, the fictional country, dependent on rice, but they're kind of highly sensitive to volatile weather. And while there is finance available in the market, the cooperatives are constrained because the financing available is at very high interest rates or in very small loan sizes. So similar to the kind of the situation that that was mentioned earlier that Anna mentioned in Ghana. Loan officers are potentially interested but are generally reluctant to lend to cooperatives because they're just not familiar with agricultural lending. And the government does place some strict regulations on starting businesses as well as tough requirements for documentation. So as we mentioned at the beginning, I think that obviously the most important thing to do at the initial stages is kind of diagnose what the barriers are. What are we seeing as why there are some challenges to actually these cooperatives receiving finance. So maybe just take a quick minute or a quick few seconds and just jot down some thoughts. And if people want to either throw out ideas or to type them in the chat window, that'd be great. And then we can go to the next stage, which will talk about some of the kind of the barriers and talk about what we can do about them. So I'll just pause here for people to kind of gather their thoughts. Do write something in the chat window, and then we can move on to the next phase. Yeah, got one suggestion from Anna, interest rates and deficits. Definitely high interest rates and deficits, definitely, yep. Any other thoughts from anyone else? Thanks, Anna, for sharing your thoughts. Yeah, so that's definitely definitely a big one. So the reason for the kind of the high interest rates is definitely because, you know, agricultural lending is just perceived as being very risky by the bank, and so they're compensating for that risk and what they perceive as kind of the opportunity cost by charging high interest rates. That's essentially how they're going to make the money, and they have low risk tolerance. So clearly they see it as a, you know, they don't necessarily want to make the investment, so they need to make it palatable for them. There's also this mismatch between kind of what financing is needed and what is provided in the market, as well as complex regulatory procedures. So think about what a desired outcome could look like. We want essentially lending to be available for these cooperatives. We want lending to continue after the guarantee ends, if in fact the guarantee is correct. We want decreased collateral requirements. We want more conducive regulations. We want increased local investment generally in agriculture. So given what we know about DCA, and that DCA has these kind of 5 different products, I think 2 questions. One, does DCA make sense in this case? And if so, which is the best DCA tool to use? And then 2, to the point that Megan was making earlier, obviously DCA is at its most powerful when it's paired. It's kind of seen as a constellation or a portfolio approach. So what are some other tools that it can be paired with to achieve these outcomes? And so if you go to the next slide, well, just as a recall, you know, there are these 5 DCA guarantee products. So if we look across these, and again, based on this very limited information you know on this fictional case study, which of the 5 products do we think is best suited for this purpose, to kind of help the cooperatives, get access to financing? And then second question is, what other tools may be helpful in this circumstance? So again, I'll pause here for just a minute. And again, if people want to answer the first question or the second question, first question being which DCA product, if it's in fact helpful, and the second one being what other tools could be helpful. And again, just either jump in or throw your answers on the chat window. We can then present a potential answer that we came up with. It may not be the completely correct one, but at least it's a start of how you might try to solve this problem. So I'll pause here for just a minute.
Sham, I just got a private message from someone saying maybe an LPG.
An LPG, okay, interesting. Okay, which type of LPG? We're talking about loan portfolio?
I don't know. They're sending me private messages, not to the group. All right.
Loan portfolio to multiple cooperatives. Okay, great. With technical assistance and policy advocacy. It's a great answer. So if you go to the next slide, inside that is loan portfolio guarantee. So one of the LPGs, as Megan was mentioning. And I think it makes sense because it's a group of potential lendees. So it's not necessarily just one. So it wouldn't necessarily make sense just to do one guarantee to one institution, and it is for loans. I think pairing it as CWIS mentions with technical assistance, both for loan officers on how do we think about kind of risk management and kind of properly pricing risk for agricultural lending, as well as the other side to kind of improve their own productivity. And then there's definitely a role for policy advocacy here around these regulatory elements. And as mentioned, this is not a complete answer, and I'm sure there are other elements that you'd want to think about, but provides the basis for how you start to think about, okay, given given the set of issues that we're facing and the set of challenges, what are the potential solutions that work here? So thanks everyone for sharing. And I think this is, a potential example of how it could work. But I'll pass it back to Megan quickly for some concluding thoughts. And then happy to open it up in the few minutes we have left for any questions and answers, for any questions.
Great, thanks.
So back to you, Megan.
Yeah, the next slide there, just a couple of concluding thoughts. One, it's important to think about when designing the guarantee to only use it when we think a transaction would not otherwise occur, when there's genuine risk sharing, and when we have a reasonable chance that the borrower is going to be successful. Second big concluding thought is combining USAID tools can make a really great impact and can be a really strategic way to look at agriculture finance. The third thing is thinking about, are there other actors out there? Maybe there's other types of partners in the regional markets or the international markets they might want to pull in to engage. The next thing there is thinking about, what is our relationship with the bank like, and what it is like is equal risk sharing partnership. They're not our implementing partner, we are not the client, and that can be really challenging sometimes to think about, but they're our partner, and that's changes the dynamic of that relationship, I think. We also really encourage missions to think about, especially where budgets might be low, or maybe the need is just so high, as Mark pointed out at the beginning of this training, the agricultural needs are just enormous. And so maybe we need to think about, are there other donors or other partners that we want to bring into the mix that could help scale our impacts. And then the last thing, I just encourage people to be creative. Approach agriculture finance, and I really encourage missions to think outside the box and to come with different ideas, and but also sometimes the best and the most impactful solution is the very simple, straightforward one, and so not to be afraid of those either.
Fantastic. Thanks, Megan. We have one question in the chat box. Do you have aggregated statistics across regions on losses versus gains, for example, through IEs, et cetera? Do you have an answer here, Megan?
Yeah, we do. We've, agriculture, our overall loss rate, I think, is about 2.12%. And agriculture, last time I looked, was a little bit higher than that. So still very low, but it's a bit above average. So I think it's like 2.8 or something. But Anna, if you want to follow up with me, I'm happy to get you that data afterwards if you'd like. But was a little.
Fantastic. And we have one more question from Anna. How can we tackle situations like Ghana, and I think as you mentioned earlier, microprocessors or kind of SME processors kind of face interest rates of up to 30%. So would it be to work on more policy work with the government? Is it to grow agro-industry? Kind of how might you tackle a situation?
Yeah, Ghana is really challenging. I mean, and I'm not sure if you're with the mission in Ghana, but they have a really interesting program there, the FinGap program, where they are trying to look at how do we address a lot of the different types of agricultural finance challenges. And in Ghana, as in pretty much every country I've ever worked in, a guarantee alone is not some magic bullet. It isn't just a guarantee is going to solve all your problems. And the interest rate challenge in Ghana is very complicated. I mean, one thing I think about in Ghana, which I don't know if it's been tried, but looking at, okay, what's the reason why those rates are so high? I mean, part of it is the government, part of it is the riskiness, part of it is inflation. But one approach there, I mean, it depends on, I'm not a Ghana expert, but one thing I've thought about there is, are there things that you can do on the capital market side that would help get longer term, cheaper capital into those banks? So I'm thinking about some bond structures where you're able to help those institutions get that cheaper, longer term capital. I don't know. Ghana is very hard. I welcome others' feedback on that. I'm certainly not an expert in Ghana, but I do know that's a really, really challenging atmosphere, and that FinGap program has done some pretty interesting stuff there.
Fantastic. Thanks, Megan. So I know we're at time, and so I don't want to keep everyone longer than we have to. But I really appreciate everyone's participation today. Big thanks to Megan as well for taking us through the majority of the content, as well as to Mark. And if there are any questions, feel free to reach out to myself, to Megan, to Patrick, and to Mark directly, and we're happy to kind of answer any follow-up questions. But a big thank you from all of us for participating, and hopefully this is helpful to you.
Great. Thank you.
Thanks so much.
Thanks,
Yep.
everyone.
Bye.